Are you paying more taxes than you should be? Here are 5 ways that you can legally lower your taxes as a business owner. Hey guys, Jerry here, member of the W.A. Smith team. I'm a CPA with 30 plus years of experience in the tax field. Here at W.A. Smith, our mission is pretty simple. We want to worry more about your life and less about your money. In essence, give you financial peace of mind. I'm your guide today to give you 5 ways to legally reduce your taxes as a business owner. And this is going to be a high-level discussion to at least get you on the road of thinking about, hey, what's available? What should I be doing? What could I be doing? So let's jump in. So the first topic we want to talk about as it relates to tax savings is business structure. So not all businesses are created equal. They have many factors. There's many reasons why one makes sense for one business owner and another one makes sense for another business owner. You have LLCs, you have S corporations, C corporations, partnerships. Types of income matter. Amount of owners matter. How you pay yourself matters. And your business could evolve also. You could start one place and maybe you get to something else because, hey, it was a side job, a hobby kind of a business, and now it's something totally different. Well, at that point, you need to have that discussion. And depending on the type of business structure, that will indicate the type of taxes that you will pay, the layers of taxes, self-employment tax, income tax. It'll also have an impact on the types of deductions that are available to you as well. So that's how the business structure comes into play when, hey, it's not everything is created equal. They all have their pluses and their minuses, and the idea is what's right for you. So I'm just going to put that up there. That's okay. It don't matter. Wall. Boom. That kind of doesn't work either. Boom. 3rd time's a charm. Boom. 1 down. Topic number 2, retirement plans. Do you have one? Do you not have one? Do you need one? You know, this has an impact on your taxes in terms of deduction. So when you have a retirement plan, depending on the type of retirement plan, that will indicate the type of deduction that's available to you. It could be a deferral off of a salary. It could be a business deduction, like a profit sharing plan or a SEP or a simple matching contribution. Depending on the type of plan, that'll indicate what is available to you. So whereas one plan might make sense in the infancy of a business, another plan might make way more sense later on as cash flow expands, as the amount of employees that you have expands, as the legislative rules change. There used to not be Roths. There's something called a Roth. There's a Roth 401k now. So there are other opportunities that happen along the way. So again, the type of plan will dictate your deduction, which your deduction will have a direct impact on your income tax liability. Number 2, check. Number 3, topic number 3, owner's compensation. You might be thinking, well, yeah, that's easy. It's what I pay myself. And yeah, I agree, it is. It's what you pay yourself. But there's a strategy behind it. There's a purpose behind it. There could be an IRS purpose. There could be a retirement funding purpose. There could be a deduction purpose. There's something called qualified business income deduction that when you're a business owner, your business compensation doesn't get used in that calculation. So that's where some of the strategy comes into play. If you're funding a retirement, the amount of compensation will dictate what you can do from a retirement standpoint. So although it's money's coming to you, how it comes to you has a direct tax impact. If you have a wage, it's got self-employment tax attached to it. If you're an S corporation, for instance, a distribution, that's only subject to income tax. If you're a C corporation, you might be paying yourself a dividend. So when it's all said and done, all compensation, all forms of compensation, but all taxed a little bit different. And there's other strategies related to that that could be used to supplement that compensation, maybe from a deduction standpoint, which is what we're going to talk about next in topic number 4. Check. Topic number 4, deductions. I'm going to talk about a few deductions here. There are many more, but when I kind of put this list together, I thought about when somebody asks me, hey, what don't I know but should know? So there are a few deductions that are like that. 280A, for instance, is a deduction that allows you to rent your home from yourself, take a business deduction. The income that's being paid to you is excluded from tax. So it's a deduction on one side, but no income on the other side. Now, this is a proactive deduction. There is documentation and support, and there are rules related to how this deduction is substantiated so that if there is a question, you've got all your I's dotted and your T's crossed. Home office. Do you operate a business out of your house? If you do, there's an opportunity for a deduction related to expenses that are part of your household. Utilities, insurance, maintenance, repairs, real estate taxes, to name a couple. There are more. There are methods that can be done in order to calculate this deduction. You've got square footage, you've got number of rooms. The IRS, again, this is in the tax code. They have publications that kind of guide us through what's available and how to do it. Again, a proactive deduction, something you have to be thinking about forward, not backward, not reactive. Third deduction I want to talk about is, and if it applies to you, great, and if it doesn't, well, maybe someday, or maybe it will somebody else, employing your kids. So I know I have children. I know how much my kids cost. This is a way that allows you as a business owner, if you've got something that needs to be done, you can pay your child. Your child then gets a W-2, has income, you get a deduction. The Tax and Jobs Act of 2017 greatly increased the standard deduction, which allowed us to have more income not subject to tax. So it raised that standard deduction to about $12,000. So in theory, if you think about it, you could pay your child up to $12,000 and have no income tax on that side, but you're getting a deduction on the other side. And then to make it even more powerful, you could fund a Roth IRA with that earned income, because now your child has some earned income. So a powerful opportunity, a powerful technique that helps today and helps as we're moving on into the future. Again, there are many more deductions that we can talk about. Topic 4, check. Item number 5, tax credits. Again, and you're going to hear me, you've heard me say this, you're going to hear me say it again, this is proactive. This has to be done during the year. This can't be done after the year. There's documentation, there are supporting items that you have to accomplish. But before we get into all that kind of stuff, let's talk about what's a tax credit. A tax credit is a reduction of your tax liability. So if you've got a $1,000 tax credit and a $1,000 tax liability, basically it nets out to a zero, where a deduction only reduces your income. And I say only, But a deduction could be more powerful than a credit, but a credit most of the time is a little bit more powerful than the deduction. For small business owners, there are a lot of credits available. There are, for instance, there's a work opportunity credit, which if you're hiring or have hired a veteran, that can get you a credit. If you pay for your employees' health insurance premiums, there's a credit for that. If you do research and development, there's a credit for that. There's a bunch of energy type credits. There's a credit if you're a restaurant owner. There's a credit if you're paying Medicare and Social Security on tip income for your employees, to name a couple. But there are a ton of credits available. And if you're not thinking about that, then you really should be. But again, it's proactive. This is stuff that's got to be done before. It can't be done after. We can't be reactive with this. Check. That covers the 5 topics. I did that at a very, very high level. I could probably spend a whole segment on each one of these topics for us. But what I really want to drive home is that this is proactive. This is planning. These are items that really need to be thought of, and these are items that need to be brought to the table before you're filing your income taxes. This stuff has to happen beforehand. It's got to be proactive. Now you're ready to do some tax savings. I know I talked at a high level. If there's anything that you want to hear a little bit more on, drop a comment or a question down below, and I'd be happy to expand in another video, whatever you all want to hear. Hit subscribe, and now I'm going to pass the light bulb to your next guide in the next video.